Quantitative easing. With the ongoing pandemic, you may have heard this term thrown around in the news. Maybe looking at this phrase makes your mind draw a blank and you have no idea what it means. Or maybe you're already an economics expert and you know all there is behind this monetary policy. Whatever the case, this video aims to investigate the impacts of quantitative easing during recessions and evaluate the efficacy of such a monetary policy. I will start off with an explanation of what quantitative easing is, for those of you who don't know, followed by an overview of the history of the topic, a description of the current controversies surrounding this policy, and then finally how past implementations of quantitative easing can help us critique the supply and demand model since QE is built off of this theory. First of all, what is quantitative easing? Quantitative easing is a form of unconventional monetary policy where a central bank purchases government bonds and other financial assets in order to increase the supply of money and expand economic activity. The premise is, as the supply of money increases, the value of money decreases, which results in lower interest rates that encourage consumers to borrow and spend more money. By buying these assets, the central bank is essentially adding new money into the economy and lowering interest rates. You could think of it as though the central banks are creating money out of thin air, usually when the country is in recession, with the goal of stimulating the economy. This is different from conventional expansionary monetary policy, where the central bank tries to induce private banks to create new money, which encourages borrowers to take out additional loans with lower interest rates and thus stimulate more consumer and business spending. Thus, with quantitative easing, the central bank is doing what private banks do every day, creating new money by advancing credit and/or taking over loans from other lenders, namely the institutions or investors which already own them. Now, what's the history behind this policy? Quantitative easing is supported by Keynesian economics, with Keynes advocating for such a policy in his book, A Treatise on Money, back in 1930. Amidst the Great Depression, he proposed that central banks should buy securities to further decrease interest rates. Indeed, many consider the policies implemented by the U.S. Federal Reserve in the 1930s to be quite similar to the recent implementations of quantitative easing across the world. Back then, the central bank bought $1 billion in Treasury securities over a period of 2 quarters and brought down interest rates dramatically. It wasn't until 1995, however, that the term quantitative easing itself was coined by German economist Richard Werner in the context of the Asian financial crisis. Following the Asian financial crisis, Japan fell into a deep economic recession. In 2001, Japan's central bank, the Bank of Japan, decided to implement an aggressive quantitative easing program to stimulate the economy. The bank bought Japanese government bonds, private debt, and stocks, increasing commercial bank account balances from 5 trillion yen to 35 trillion yen over a 4-year period starting in March 2001. However, despite all of these efforts, the program failed to meet its goals. Japan's GDP actually fell from 5.45 trillion USD to 4.52 trillion USD in nominal terms between 1995 and 2007. Following the global financial crisis of 2007 to 2008, quantitative easing was also implemented in the United Kingdom, a variety of European countries, and perhaps most famously, the United States. From December 2008 to October 2014, the Fed launched 4 rounds of quantitative easing to fight the 2008 financial crisis. They had resorted to quantitative easing because other expansionary monetary policy tools had reached their limits, with the Fed fund rate and discount rate already at 0. Over the course of the 4 years, quantitative easing added almost $4 trillion to the money supply and the Fed's balance sheet. The Fed claims that quantitative easing was what ended the 2008 financial crisis in the United States, but there's still much controversy surrounding the efficacy of this policy. So, what is the current debate surrounding quantitative easing? Given the mixed results of past implementations of quantitative easing, there is still much discussion surrounding whether countries should actually implement this policy. While many claim that the Fed's implementation of quantitative easing has been successful, critics say it only helps stabilize the economy in the short term. Unemployment is still staggeringly high, businesses are borrowing less money, and the country is in immense debt. Yet, Both the US and Canada have now turned to quantitative easing as a way to deal with the economic turmoil brought about by the pandemic. In the United States, economists at Goldman Sachs estimate that it would take a staggering $4 trillion in quantitative easing to get the economy rolling again. This only serves to beg the question, is it truly worth it? In an article written by the Federal Reserve Bank of St. Louis, an important comparison between the US and Canada is highlighted that has also questioned the effectiveness of quantitative easing. Following the 2008 financial crisis, the central bank interest rate policy has been a little different between Canada and the US. In this case, Canada did not engage in quantitative easing over the period, while the Fed did. Looking at the numbers, in December 2016, the Bank of Canada balance sheet was 5.1% of the country's GDP, compared to the 23.6% of US's GDP for the Fed. Given how Canada and the US are typically subjected to similar economic shocks because of their proximity and similar level of economic development, if quantitative easing was effective in stimulating aggregate economic activity, we should see a positive difference in economic performance in the US relative to Canada since the financial crisis. However, as we can also see in the figure, there was little difference from 2007 to the fourth quarter of 2016 in real GDP performance between the two countries. In fact, real GDP in Canada in the fourth quarter of 2016 was actually 2% higher than the real GDP in the US, reflecting higher cumulative growth even though they did not implement quantitative easing in the first place. So, while the economic policy was deemed to be a success in 2008, the United States may not have needed to resort to quantitative easing, especially considering the sheer amount of debt such a policy has caused. That being said, much of this is resting on what ifs, and the debate is still ongoing. Beyond the efficacy of the actual policy, economists worry that there are negative side effects to quantitative easing. Lately, more and more economists have been discussing how quantitative easing has worsened wealth inequality over the years. As the stock market soared, wages stagnated, and the only people that could take advantage of the sudden surplus of money were the wealthy. Kevin Warsh, a former Fed board member, explained that quantitative easing works purely through an asset price channel that enriches the few who own stocks or other financial products instead of the 96% of Americans who receive the majority of their income through labor. Indeed, international data also shows that wealth inequality is falling globally, but not within developed countries with quantitative easing programs. To top it all off, in 2012, a Bank of England report showed that its quantitative easing policies had benefited mainly the wealthy, and that 40% of those gains went to the richest 5% of British households. Finally, I'll be talking about a critique of the supply and demand model through a quantitative easing lens. As I explained in the beginning of this video, the premise of quantitative easing is built off of the aggregate supply and aggregate demand model. Since increasing the supply of money should decrease consumers' demand for money, so they don't hold on to it, and thus cause them to spend more. However, there are some flaws with this model. First, according to the Federal Reserve Bank of St. Louis, this model fails to explain asset bubbles that can cause recessions. The conventional supply and demand theory assumes that the expectations of consumers do not change as a consequence of price changes. However, in scenarios like the US housing bubble in the 2000s, an initial price of an asset can increase the expectations of investors, which actually causes the asset to be more lucrative. As a result, the price will continue to increase until the market sentiment changes. It's basically a positive feedback loop that will eventually end when the bubble bursts. This is exactly what caused the Great Recession in 2008. These asset bubbles cannot be explained in the conventional supply and demand framework because this model assumes a price change will be self-correcting and that the system will snap back to equilibrium, which actually isn't the case. In a quantitative easing lens specifically, this monetary policy should be effective if the aggregate supply and aggregate demand model is accurate. However, we know that quantitative easing has had mixed results. As I mentioned earlier, Japan's GDP actually dropped by close to $1 trillion after they implemented quantitative easing in the early 2000s, meaning the increase in the aggregate supply of money didn't actually cause an increase in spending. Why might this be the case? Some Keynesian economics theorize that aggregate demand is actually insensitive to interest rates. If true, this would go against the conventional supply and demand theory. The interest rate effect states that a change in interest rate would lead to more investment spending and more interest-sensitive consumption, which is exactly why central banks implement quantitative easing and drive their interest rates to zero to encourage spending. A study done by two members of the Federal Reserve Board, Stephen Sharp and Gustavo Suarez, in 2015, found that most firms claim their investment plans to be quite insensitive to decreases in interest rates and only somewhat more responsive to interest rate increases. While much of the study was based on data collected through qualitative surveys, this does bring up an interesting point that may explain why quantitative easing has yielded rather inconsistent results in the past. This finding is further supported by a Reserve Bank of Australia study, which concluded that low interest rates do not directly encourage investment. All in all, I hope this video has sparked your interest in the ongoing quantitative easing debate. While a lot of the statistics and information I used in my research process were sourced from articles and studies that have looked at past implementations of the monetary policy, we can also keep up with what's currently going on in our very own country. Now that the Bank of Canada has implemented quantitative easing for the past year and is buying roughly $4 billion worth of government bonds per month, it will be especially interesting to stay up to date with this program and see whether it will truly be successful in helping the Canadian economy bounce back from the pandemic. After all, what better way to analyze a policy than to look at a real-world implementation right at home? Thanks for watching.